In this video we are going to talk about Dividend Aristocrats. So before starting, please like this video and subscribe to this channel for our future updates. With the fear of rising interest rates and the current invasion of Ukraine, it's becoming increasingly difficult to find certainty on Wall Street these days. On the other hand, reliance on so-called dividend aristocrats is a method by which investors can tap into more predictable returns. Besides paying dividends for an extended period of time, these unique stocks have a track record of increasing dividends at least once per year for a period of 25 years or more. The following 9 stocks are all characterized by a long-term commitment to dividend growth as well as current dividend yields that are higher than the usual S&P wink with tongue sticking out 500 company. A sure bet does not exist, but dividend metrics such as these provide greater assurance than you'll find anywhere on Wall Street these days, which is a good thing. Number 9. Cardinal Health Inc, CAH. Cardinal Health is an integrated healthcare corporation that provides products and services to hospitals, doctors' offices, nursing homes, and other comparable facilities all over the world, including the United States. Medical tools, laboratory supplies, and other miscellaneous items, such as exam gloves and bandages, are all distributed under this category of business. Even though Cardinal's business does not generate as high a profit margin as companies that specialize in branded drugs or high-tech surgery robots, it is one of the more reliable revenue streams because its customers have strong baseline demand for all of the basic medical goods that the company distributes. As a result, the company has been able to keep making money for 35 years in a row by raising its dividend. Number 8. Chevron Corporation, CVX. While many investors would be content to possess a stock that only managed to post a marginal gain in 2022, Chevron has delighted its shareholders by posting gains of over 30% since January 1, largely as a result of increased crude oil prices. As a result of broad inflationary pressures, such as consumer prices rising at their quickest rate since 1982 in January and supply chain disruptions as a result of the conflict in Ukraine, oil has reached more than $100 per barrel this month. Regardless of short-term trends, CVX shareholders can rest assured that the company will continue to pay its large dividend. During the previous 35 years, Chevron has increased its payout every year, and the company resumed the practice in February by increasing it by another 6%. Number 7. Cincinnati Financial Corporation, CINF. Cincinnati Financial is a property and casualty insurance carrier that provides coverage for commercial real estate, automobiles, homes, boats, and other valuable assets. This coverage is maintained in both good and bad economic times, resulting in a slight profit for the company's shares year to date, despite the fact that much of Wall Street is down. The chances for higher interest rates are also favorable for CINF, which has an investment arm that invests the cash generated by premiums in low-risk, interest-bearing assets while the insurer waits for claims to be received. When you factor in the company's excellent track record of 61 consecutive annual dividend raises, you have a dividend aristocrat to keep an eye on. Number 6. Consolidated Edison Inc, ED. CON provides electric service to over 3.5 million customers, most of whom are located in the New York City metropolitan area. The company was founded in 1823 and is one of the oldest publicly traded utilities on Wall Street, with a market capitalization of $13 billion. With 48 straight years of dividend increases, it also boasts one of the longest streaks of yearly dividend increases among large companies. In January, it increased its quarterly dividend to 79 cents a share from 77.5 cents a share, making it one of the most generous in the industry. Even while the rise isn't significant, the fact that ED yields approximately 3 times the usual stock in the S&P 500 already demonstrates this utility's long-term commitment to sharing profits with its shareholders over the long run. Number 5. General Dynamics Corporation, GD. In addition to manufacturing nuclear-powered submarines for the Navy, General Dynamics also builds crude oil tankers for customers in the oil and gas industry. Artificial intelligence and big data technologies for logistics applications, as well as other high-tech and very profitable equipment, are also produced by the company. In part as a result of geopolitical tensions created by Russia's invasion of Ukraine, the price of General Electric stock has risen by more than 11% in 2022, despite an otherwise rough market for stocks. This year's dividend rise will be the company's 25th straight year of dividend increases, demonstrating the company's long-term commitment to shareholders. Number 4. Nucor Corporation, NUE. As a result of the inflationary climate, stocks dealing with raw materials have done exceptionally well. Nucor, the world's largest producer of steel products, will benefit from this favorable environment as its stock has risen by more than 110% in the last year. Because the company specialized in beams, sheets, tubing, and rolled steel, it has seen a significant increase in demand as the economy recovers from the epidemic, as well as an expansion of profits. Rising commodity prices have contributed to this growth. For income investors, the fact that Nucor has increased its dividend for 49 straight years, every year since the company began paying dividends in 1973, is the most compelling aspect of the company. That implies that even if the stock market doesn't continue to soar, you can still count on a consistent and growing income stream. Number 3. People's United Financial Incorporated, PBCT. Popular United is a regional bank with roughly $8 billion in assets and approximately 400 locations across the states of New York, Maine, and Massachusetts. Despite the fact that these smaller financial institutions aren't as flashy as the big investment banks, they are significantly more stable in their operations since they rely on meat and potatoes financing such as home mortgages, small business lines of credit, and other similar items to survive. As a result of rising interest rates, PBCT has been able to swim upstream in a turbulent market, and its shares have gained approximately 9% so far this year, despite the fact that the S&P wink with tongue sticking out 500 has fallen approximately 10% during the same period. PBCT is a financial services company that provides loans to businesses. As of 2021, the company had raised its dividend for the 28th year in a row. Investors should expect that trend to continue in 2022 as well. Number 2. Cisco Corporation, SYY. Cisco Corporation, a food service company, supplies meats, vegetables, dairy products, beverages, and non-food items such as disposable flatware and napkins to industrial kitchens and food processing plants. Restaurants, as well as college cafeterias, hospitals, and other comparable facilities, fall into this category. During the epidemic, SYY stock took a significant knock, but it recovered beautifully in 2021 when food deliveries began in earnest to eateries that had been forced to close during the worst of the pandemic restrictions. In 2022, the tailwind is expected to persist, with predictions of a more than 20% revenue increase for the current fiscal year. As a firm that has grown its dividend once per year for more than 50 years, it should come as no surprise that Cisco has worked hard to sustain its dividend payments to shareholders even in the face of significant challenges. In addition, dividend growth is expected to keep going in the future, which gives investors a reason to be happy. Number 1. Abbvie Inc., ticker, ABBV. ABT said earlier this year that it was separating its branded medication operations into Abbvie, a move that took effect immediately. But if you go back farther in time to the company's inception, you will learn that the corporation has seen an astonishing 49 consecutive years of dividend growth. The risk associated with branded medications is higher due to the possibility of patent expirations, but Abbvie has a strong product pipeline and a track record of large acquisitions, such as its $63 billion acquisition of Allergan in 2020, to ensure that it remains at the forefront of the pharmaceutical industry. Furthermore, given the fact that ABBV's dividend has climbed from 40 cents per quarter at the time of its 2013 spin-off to $1.41 per quarter at present, there is ample proof that this company is putting forth significant effort to guarantee that its shareholders have a piece of its success. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.